Welcome to today's Dealmakers event on the outlook for 2026. I'm Lucina Shen, deals reporter at Axios Pro, coming to you from New York. Welcome to our audiences on Facebook, YouTube, X, LinkedIn, and on Axios.com. Today, we're digging into the forces shaping next year's deal landscape. AI-powered investment, shifting valuations, policy pressure, and what the next cycle means for founders, operators, and investors. Join the conversation today on X with @Axios and hashtag Axios Live. And with that, let's jump into our first conversation. Our first guest is Shan Chan, investment manager for private companies at Bailey Gifford. Shan, so great to have you.
So great to be on the show.
So Shan, Bailey Gifford's been in some really mega gigantic companies. You've been in Tesla, Anthropic, SpaceX, Stripe. So I'd love to hear your perspective of what's going on right now. And for context, right, the data that we've seen is that there's been a large concentration of investments towards the growth rounds. So $9 billion plus financings accounted for almost 40% of Q3 deal value, according to PitchBook. What is going on, and why are we seeing so many investors putting so much concentrated capital into these companies and these names?
Yeah, I think to set the stage and actually very timely, we're going through some of these market reviews at the same time. The first half of 2025, we saw almost $80 billion deployed in venture growth. And if you kind of analyze that, let's call it round number six, 160 billion deployed in our land. That is actually surpassing the 2021 peak. And I think there are a couple of nuances here worth noting. The first you already mentioned is there's a huge amount of concentration. We're seeing probably a handful of companies, we can name them together, that occupied over 40 to over 50% of those pools of dollars. And I would say the second derivative, the nuance here is there's a little bit of a shift because of everything we're seeing in the industries of preference. So AI not only brought a lot of attention to the foundation model companies, but also the upstreams and the downstreams. So you're thinking about chips, data centers, raw energies, and also many of those relevance industries are naturally capex heavy. So I think some of these influx of dollars and numbers are indicating where interests lie in these type of space. And the third, I would say that we actually are starting to see a little bit of a tale of two cities. So you have these really highlighted, most attentioned, wanted companies that are capturing dollars. But on the other side, we're also seeing many companies in the not so high attention space emerging with great excellence, discipline, business execution, and huge potential for future compounding. So I think all of this is to come back to say this asset class in venture growth, we believe is booming, is very healthy, and is experiencing a lot of attention and growth.
Yeah, so I think this is interesting because a I think you're seeing record dry powder, right? You're seeing, I think, $311 billion in the system, again, according to PitchBook data, which is not being allocated. And I think we had a conversation kind of offline where you guys were saying basically you believe that in growth, at least it is an allocated asset class. And I pushed you guys a little on that because it does feel like there's a lot of capital in this space. It's just not being deployed.
I think the way we think about this, a very good question. I've been on the road with our LPs quite a bit this year. I think you still have to come back to first principle. Believe it or not, venture growth in its current format is still a young asset class. It is relatively in this. The stage is at compared to if you think about private equities or even early venture capital or hedge funds, some of these public equity formats, it's quite young. And there are indeed a lot of dry powders gathering in the past, I think, 2 decades because of the underlying fundamentals of the companies. One part is undeniable is that these companies that probably would have debuted themselves in public market many years ago. We invested in Tesla very early on in the public market, but those type of companies I think can be mostly be found in the private market now. So I think it's strongly supported a scaling of the asset class by the fundamental of the businesses in it. And second, if you're taking the LP's perspective, it is still a very small part of the allocation basket. And third but not least, I think this scaffolding around this asset class is growing pretty fast. And you have not seen that much secondaries, tenders, even dividend payouts. These formats are emerging, and I think as healthy scaffoldings to support the long-term durability of this. So yes, to your point, we still think there's still huge potential despite the amount of dry powder going into this asset.
Yeah, so that's interesting. I mean, I feel like we've been starting to see more tenders, more secondaries. That's becoming a more common vehicle. But the dividends part is something, like what kinds of companies do you think could start doing that? And do you expect to see actually more of those coming to light next year?
We are obviously uh, had the great fortune of partnering up with some of the biggest and most well-known private large cap companies. But we've also seen some of these companies as they approach maturity, with the optionality to go public, oftentimes indicate they're having a viable path to profitability. And with profitabilities, it's kind of a capital allocation decisions. Like for companies who have been staying private for much longer, they start to think about deliberately refreshing the cap table as well as providing liquidity to employees and adjacent personnel. So tenders, dividends, and even buybacks, which are pretty common formats in the public market, are starting to emerge in the private market this year. And we've seen that was very well executed with some of the really well-known private growth businesses.
And are these exclusively, particularly on the dividends and buyback side, are these companies that are preparing to IPO, or is it the rumor mill, of course, as some companies, including Stripe, are may never IPO, right? And is that basically just happening in the private markets now to these companies as well?
Yeah, this is probably one of these hottest debates right now. I think a lot of these companies are actually very deliberately preparing, but they may not choose, or they may choose a time that is the best interest for them. Like, what do I mean by that? Actually, a lot of these medium to growth stage company come to us, working with us with something like putting together an audit committee, actually adding independent board members, or some of them have started doing basically quarterly earnings calls, but with existing investors. And sometimes we will loop in our public managers along with private managers so they can have these mock earnings calls despite remain a private companies. So I think what is underlying this is like there's a huge discipline trying to be similar at the pedigree of a public companies. The above being said, I think there's still a huge benefit in staying private. Like you can choose to strategically focus your priority on 2 quarters or a year forward versus delivering specifically on the spot of your forecasted results. So the timeline, we're never the type of investor to push company to go public. We think choosing the moment is their own decision, but getting the infrastructure ready, discipline in is what a lot of companies are starting to do.
So you guys, speaking of which, you guys do straddle a really interesting position. You guys started out in publics, then were, one of the first folks to head into privates. And so you straddle at the in between at the moment. And so you have a perspective into both markets. There's a lot of talk at the moment on the IPO markets about when the first AI foundational model is going to IPO. I should mention that you guys are in Anthropic. Do you think, as there's like a race, right, towards the public markets for some of these AI players, that there's enough investor demand out there for a $1 trillion valuation?
Um, I don't think we will ever speak on behalf of our portfolio company. So probably the best source is directly to the companies themselves. That being said, our public side of the market, I think people underestimated how drastic of a change has been happening in the public market because we all sit in private market. I sit in private market 24/7, but in the public universe, there's actually a decrease of the amount of stocks publicly listed. So the universe, some of our public colleagues can coverage in the past decade or so have actually been declined. There's a lot of, I guess, attention and also the need to see a high growth and huge potential company who represent the future. So I would say that the appetite and also the promise of getting involved with these companies are definitely very positive. I think one of the advantage we do have is that we are sharing informations like our managers across the floors between public and private are often in talks with each other. So, like whenever we made a AI investments or infrastructure or model investments, we will obviously be sharing some of these expertise and getting the expertise from our public colleagues. So the knowledge transfer to us is highly valuable. And I think the public investors also appreciate these companies represent the frontier. So
Right. And so just to be clear, even without naming any names, like you do think that there is space for a $1 trillion listing, like there is space for a $1 trillion valuation at least at IPO.
if you're asking about the creation of market cap and the potential of the companies being created in private market, then yes, of course.
I think that will be really exciting to some investors. Of course, lastly, there's been a lot of talk about the AI bubble out there. Are you seeing opportunities, right? Given all the investments that have flooded into AI, are you seeing opportunities that are being not invested in enough?
That's a very good question. I think to your first point of bubble, you and I chatted a little bit. I've been in the valley long enough that I actually see bubble as a feature, not a bug. I think having promising capital supporting groundbreaking big ideas is actually ultimately beneficial to the societal progression and also how tech is advancing forward. But we are seeing a lot of areas who are less highlighted at this moment. And actually, we've seen very, very interesting business model emerging from that. So this could be, supply chain logistic or infrastructure custodianship in the financial ecosystem, or cross-border alignments of trades, and also even I think some of these pan-Europe businesses been growing really well. Bending Spoon, one of our portfolio companies, been receiving a lot of attention recently, and I think they pay a lot of attention to like how to create value with a lot of the product and user and the demographic of the end consumer they're serving. So yeah.
Okay, great. Unfortunately, we are out of time. Thank you, Shan, so much for joining us today.
Great to be here. Thanks so much.
And now I'll hand things over to Allison Murphy for our view from the top segment.
Thanks so much, Lucinda. Good afternoon. I'm Allison Murphy, COO of Axios. A big thank you to Cooley for making today's event possible. Joining me now is Ben Beerley, partner at Cooley. Hi, Ben. Thanks for joining us today.
Hi, Allison. Great to be here. Nice to talk to you.
Well, let's jump right in because we have plenty to talk about. Let's start big picture. 2025 seemed like a comeback year for deals. What stood out, and can the momentum carry into 2026?
Question. And M&A is certainly back in a big way. And I think one of the leading indicators is I've been sick since November and can't seem to get healthy. And I think that's because of the level of busyness we've all been seeing. I would say 2024 was really about planning, and early 25 was all about planning. I think we spent a lot of time with our clients talking about how to roll out M&A strategy. And really, since the back half of 25, it's all about execution. And we've been really busy in the trenches just doing the deals that people have been kind of waiting to get rolled out. Big moves in the billion-dollar plus category of deals. I think that just shows the level of confidence people have in the market. I think we're about 20 to 25% up year over year on billion-dollar plus deals, which is great for people like us who do love doing the kind of like larger transactions that are transformative. And with the macro economy kind of staying steady, we're expecting that trend to continue into 2026.
25%, that is not a small increase rate. Let's double click on that and talk about tech deals specifically and thinking about AI. Is this current AI gold rush we're seeing, is it going to be a durable driver of M&A, or is this really the next bubble?
Yeah, I think in the near term, the answer to that question almost doesn't really matter because I think 2026 is going to be big in AI, kind of regardless of what the long-term trajectory might look like. It's just on everyone's bingo card is either to build an AI solution or to buy an AI solution. And I think it's that buy component that's going to be keeping us busy here in the near term. Longer term, a little bit tough to tell. It could kind of break one of two ways. The first is it looks a little bit like cybersecurity and just becomes a big part of the ecosystem and is a separate segment of the market, if you will, that folks are going to continue to spend a lot of time both identifying and executing on. And if it doesn't break that way, and maybe it becomes a little bit more like the Internet of Things, as people might remember from a few years ago, where it was a oft-touted solution, but never really gained the traction as an independent vertical, and was really subsumed more into the broader tech ecosystem. But I think too early to tell what the long-term plan or trajectory is for AI. But in the near term, like I said, it's going to be very much a part of the M&A landscape for the foreseeable future.
Of course, one of the other factors can be regulation. So, where does antitrust land in 2026 for big tech and for biotech? Are mega deals really going to be able to come back?
Yeah, I think the one word answer on antitrust is just confidence, which is great for people like me who do deals day in and day out. Is people just feel better knowing what types of deals will get scrutinized and will be subject to additional regulatory review, and which ones are more likely to get done more quickly. The last administration was trying a bunch of different theories and different ways of looking at matters, and that caused people to not know going into deals, is my deal going to get an additional level of scrutiny? Or can I just plan that this is going to be a plain vanilla type review that we can have a good line of sight to closing? So I think with that level of confidence, both here in the US and abroad, is really helping people feel confident to take bigger bets on transactions because they feel like they know the likelihood of approval. We're also seeing antitrust show up as a strategic differentiator in transactions, as you might have seen in the Metsera-Pfizer transaction. Pfizer's ability to get that deal through the regulators in a quick manner really helped it make sure it was able to succeed in what could have turned into a longer, protracted, hostile transaction. And we're seeing it, just today with the news on the Warner Brothers transaction and Paramount saying that they think they have a better, faster path to closing than Netflix might have. And I think all of that is just more fodder for parties and transactions to talk about how successful they may or may not be relative to others. And so it's not just the dollars on the table, but it's also how successful are you going to be able to close that deal so those dollars ultimately can get delivered to the stockholders.
Absolutely. And that's a great segue into our last question today, which is if we're thinking then about who's going to have the upper hand, you mentioned some of the things that can make a difference. But if we're talking 2026, who has the upper hand, corporates or sponsors?
Yeah, I think that's a great question. I think the answer might actually be sellers might have the upper hand for once. We've been in a very robust but pro-buyer market for a long time, and that's really meant that buyers have been able to kind of push their weight around and get the kinds of terms that they look for in transactions. But now we see that both sponsors and strategics are back in the market in a big way. Strategics, I think, have been seeing sponsors gobbling up a lot of the assets that they were looking at, and that sense of FOMO of needing to be active in the market has really kicked in. And as a result, in a lot of the auctions that I've been working on, we're seeing not just sponsor interest, but also strategic interest. And as a seller, that just means more opportunities to play parties off against each other and get better terms. So it may be a turning of the coin here, where into 2026 we start to see more seller favorable terms, and that would be a great result, I think. Regardless, an active market is good for all of us. I think it shows confidence, and it shows that we'll all be busy well into 2026.
For sure. And thank you for all of that insight. We are definitely here at the end of the year, and all of the predictive power and knowledge you have helps us figure out 2026. So thanks so much, Ben, for joining Axios. Really appreciate you spending time with us today.
It was my pleasure. Nice to talk to you.
And now we'll pass it back to Lucinda.
Thanks, Allison. Our next guest is Marcus Ryu, General Partner at Battery Ventures. Marcus, welcome.
Pleased to be here.
So, Marcus, you joined Battery in 2022, but before that, you were an operator and you were co-founder of insurtech company Guidewire, which is now $17 billion in valuation on the public market. I want to kind of go through a historical perspective of this and your time as an operator. When Guidewire was first founded and just before you guys decided to IPO, that company had only raised about 30 million, right? Effectively before it went public in 2012. Now companies are in the VC space are raising billions before they've even hit revenue. In your mind, are we already in a bubble again?
Well, it depends on your definition of a bubble. One definition is when people buy assets only to hope to trade them to someone, to flip a meme stock or, buy an NFT and find someone else who will buy it for, 10 times the price next week. By that definition, I don't think we're in a bubble. There's another definition, which is to say that, people have overly optimistic expectations of the value that will be created by, this or that technology. Obviously, attention LLMs are the theme of the last few years, and their opinions will differ, right? But certainly expectations are sky high.
They're sky high. I mean, you're seeing spinouts that are raising billions before they've really had a business
Mhm.
model. Um,
Mhm.
to you, I mean, right, to you, where are the points of pressure, right? Where do you
Mhm.
see certain risks?
I think the single biggest risk is whether, at the most fundamental level, whether AI will generate the kind of scale of consumer and enterprise value that it will require to justify the, approximately $1 trillion of capital expenditure that's gone in so far and the multiple trillions that are anticipated to go in. So I think there is very broad consensus that there's a lot of fundamental value there, but the magnitude and the time frame on which it's realized, I think reasonable people can disagree.
Yeah, like there's a possibility, at least in your mind, that this crop of companies, it might not be I think a lot of folks
Mhm.
are seem to be betting that this is going to be coming very, very soon, right? Um, that the inflection point in your mind, there's a possibility that it doesn't come in like 10, 15 years. It might be like the EV conversation or the kind of auto driving situation.
Indeed, well, we're an optimistic species. Whenever there's a new technology, we assume that it will transform the world overnight. Things generally take longer than that, but then people, as they say, often underestimate the impact over a longer time frame. Anyone who studies, early stage companies will know that the mortality rates, even for companies that are off to a good start, is incredibly high. Most companies just don't make it. Often the first stage winners are not the ones who ultimately win the race in the longer term. And there's absolutely no doubt that those truths will continue to hold in this era too.
Yeah. Well, so run me through what you're actually seeing, right? Because you're investing a lot in early stage. You're doing internship, but
Mhm.
you're also looking at kind of enterprise SaaS companies that are
Mhm.
more directly focused on AI as well.
Mhm.
Does this parallel, right, how they're operating? Does this parallel past bubbles, or in your
Mhm.
mind, is this different?
Well, I mean, every company, well, regardless of the business, regardless of whether you're selling data or core system software or financial system software, whatever it might be, is impacted by AI. There is an extreme or kind of maximalist point of view that if you're not an AI native company, then you have no future. I certainly don't believe that, and I don't think many people who've spent their time in the software industry for any meaningful period, would agree with that. But there is absolutely no doubt that AI, will clearly inform some of the most transformative functional improvements and business value that's created by software. It's often a critical point of ingestion for new information. It's a source of explainability. It transforms the interface that people use to interact with the software. All of these things are very powerfully informed by these new advances. But who will win, whether there will be completely new entrants or whether there'll be incumbents, I think is a contest that differs market to market.
Yeah, so then let's talk about the converse for a second, right?
Mhm.
Where like battery, for example, is often known for being kind of this boring investor, right? You're picking bets that are often considered like either SaaS or recurring in that sense. And so when you're looking at the market today, where are you seeing pockets of opportunity and pockets where valuations are making sense, perhaps, or even undervalued?
Yeah, I would say that battery would generally describe itself as seeking fundamental value rather, but I will embrace the boring handle. In my company journey,
You
I
guys
used to
wrote it
say
in a
we were
blog.
we're a boring company, and that's okay because most fundamental value is boring, at least at the outset, and it's only when it accretes over a long time that it starts to get really exciting. Battery is a generalist software investor primarily, and we look across every different industry, horizontal software, vertical, data businesses, marketplaces, anything that's technology informed. And I would say that there's opportunity across the spectrum. There are AI native businesses, and there are businesses that are not in the first instance, AI businesses, but the interface or the way that data gets into the system, may be powerfully accelerated or improved by AI. So I think it's never been a better time to be an entrepreneur. Software is infinite in its potential scope. Risk capital is comparatively abundant, and it's really never been a better time to start a company.
Do you also think that in some senses, though, I mean, this is one criticism I've heard, right, is that it's actually gotten a lot easier to copy and spin up companies at the same time that are competitors because of the coding tools that we now have in play because of AI?
I think it is true that the kind of the immediate activation effort, to have a company or a plausible product in the first instance, is probably lower. But I would not say that overall that's the case. That it's easier to start a company, or that it's easier to build a company with really successful prospects than ever before. I don't think that's true. I think for one, talent is very heavily competed for, and I think that almost every interesting functional domain is now competed over by multiple entrepreneurs, all very smart people going for the same prize. So the competitive intensity is a lot higher, even if it might be easier to get an initially plausible product off the ground.
I want to ask you a little bit about the vendor landscape, the competitive vendor
Mhm.
landscape. It does seem as if, right, we went from a period of mega rounds of let's go
Mhm.
after everything index investing, as it was called at the time in kind of the pandemic ZERP era,
Mhm.
to a lot more careful investing. It was folks were focused on seed and Series A for about 2 years, and now we seem
Mhm.
to be rushing dramatically into just very very late into, well, not, I shouldn't say late stage, but mega rounds, right? Even at Series A
Mhm.
and seed, um,
Indeed.
billions, right, into the very
Mhm.
first check.
Mhm.
What, right? What is going on there?
Well, this is not ZERP era investing. I think at that time, arguably, there were very powerful incentives just to deploy capital as fast as possible, and some of that was perverse, and there was a very natural and inevitable pullback from that. At the same time, just the sheer amount of global risk capital that's available is enormous, and the potential prize for winning in certain markets, such as foundational models, is perceived to be an astronomical. And so the valuations, just the basic laws of supply and demand have bid up some of those valuations to really eye-watering levels. Whether or not those are justified, only time will tell. But I don't think it's
Yeah.
necessary, and it's certainly not our philosophy as a firm that it's necessary to win in the most extreme and competed auction process in order to find, fantastic value.
Yeah. One thing that came out from the last era, the ZERP investing era, was there was a lot of the last boom era, I should say, right? Was that there was some due diligence that was being put sidelined effectively in order to win the biggest rounds. Are you seeing, right? Then folks got tightened up again. Are you seeing some of the due diligence getting sidelined again? And like, right, or are you seeing the reverse as the AI bubble conversation comes back into play?
I think there was some very reckless investing during those few years, and there was a very natural alibi, which of course was COVID and just being difficult to get together in person. One thing that has not changed and is very different from my era as an entrepreneur is that the pace of decisioning, of the timeframes in which you as an investor have to get to conviction have tightened dramatically, and that's another function of the competitiveness. And the only answer for that is just to work harder and with greater intensity.
Yeah. So you have a history in insurtech, that it's been one of the hottest areas, one of the areas that actually, I should say, came back first, right, within the IPO market this year. And if you ask bankers, they'll still say that the IPO markets maybe are back. They're not 100% yet. What are you expecting for next year?
It's very difficult to predict. I mean, one thing that we all, everyone in the investing world talks about is just how high the hurdle is now to become a public company. It's dramatically higher than it was in my era when my company went public in early 2012. And I think that that's due to a much deeper secular factor, which is the concentration on the buy side, in which it's just the kind of minimal scale to be interesting to today's large IPO buyers is just dramatically higher, maybe almost an order of magnitude higher than it was, 10, 15 years ago. And I think that's the primary constraint or the primary issue, and I don't see that changing anytime soon.
Okay, great. Apparently best time to start a company, but very difficult time to IPO, which is an interesting dichotomy to be in. Thank you very much, Marcus, for joining us today at Axios.
Happy to be here. Thank you.
And next, for our final conversation, kicking it to Axios Pro Managing Editor George Moriarty.
Thanks so much, Lucinda. So now for our final guest today, George Matthew is Managing Director at Insight Partners. George, thank you so much for joining us.
Thank you so much for having me, George. Appreciate it very much.
Absolutely. We're going to get right into it today to maximize the time for everybody listening. George, you direct AI investing at Insight Partners. AI is everywhere and in everything. So when you have such a broad mandate, how do you choose the sectors and the opportunities that you like?
Yeah, let me start with how I saw investing in AI, particularly for the last 5 years, and what's going to be different going forward. If we look at the last half a decade or so, it was super clear that there was a lot of infrastructure to be built. And that's where Insight and the team really put a lot of our energy in really looking at all the infrastructure opportunities, whether it became the right data substrate, for instance, our recent investment in Databricks, or tools that were enabling how you would build AI systems at scale. A good example of that was, of course, Weights and Biases, which got sold to CoreWeave just a few months back. If you look at the entire stack that needed to develop in the last half a decade or so, that was a more clear way of being able to go after AI investments, particularly in the building phase that we saw. Going forward, it's super clear that now that we have a lot of this infrastructure in place, the focus really needs to be on finding those either vertical specific opportunities or domain specific opportunities. In that case, then you're absolutely right, George, that you could be just investing in any company that has slapped an AI label directly on top of their existing business. We tend to look in this current phase for companies that really started almost post ChatGPT and really building much more domain-specific capabilities that are differentiated from where the status quo of the market is. For instance, earlier this year, we made an investment in a company called Exicare, which started to really reimagine how the entire world of specialty nursing care facilities could be automated using the entire admissions care process coming from a hospital now being read in by an AI versus by a nurse. And in this case, the nurse was so proficient at that job that it took as much as 3-4 minutes per document that would be coming in to just look at what was, the possibility of admissions, and another 40 minutes of just being able to make the call of whether that patient was admissible. In this case, Exicare now can come in and replicate how the nurse is looking at that document and processing it within the speed of 30 seconds to a minute. This really opens up the entire nursing care situation where you can now automate the entire front end of that experience and now get the nurses back to doing what they do well, which is nursing. We see more and more of those native opportunities emerge where you can take AI systems and really be able to scale out how existing work is effectively happening. And that's an opportunity that we see really coming forward for the next half a decade or so, now that this infrastructure is effectively in place.
And that's really something we've seen a lot of on our side, a ton of opportunity and activity in the healthcare sector. Now, we have Dealmakers on the call listening today, so that's what you like. Like, what's an area that maybe you're less inclined to go chase or look at right now?
Yeah, I think it's a harder moment to look at a lot of the existing incumbents, particularly in the software cloud sector. If we look at many of the providers that have been building, really good businesses for at least the last decade or so, that transition of going from being a SaaS cloud provider to building AI native capabilities, much harder. And in fact, a lot of ways those incumbents have to now compete against some of these newer entrants in the AI space, oftentimes building entire workflows that can not only subsume the entirety of the software market, but also the labor function in that market as well. And so in those opportunities, we're a lot more cautious, and we'd rather either look at the earlier AI native company emerging into the sector that's providing not only the software, but the entire service layer, as well as potentially the labor pool of that specific market. And a good example of this was our investment in Relevance AI. They built full SDR BDRs that are synthetic digital workers in that space, as opposed to just providing the software for CRM or GTM tools. And so as things are getting harder in the GTM tools CRM space, we're starting to see these full digital workers, for instance, in the case of relevance emerge, which are capable of doing the work that's necessary in that specific space that not only the software was providing value towards, but really really adding to the labor pool itself. And so another great moment where AI is really transforming, again, not just the software, but the entire work that's occurring around that software. And that's another area that we're much more bullish on than, say, for instance, going after the software sector itself.
That's great. And one of the things that I'm really interested about, venture investing, always a challenge. What you bring to venture investing particularly is your operational experience. So as a former operator, and when you're evaluating these AI, what are you looking for in a manager, founder, team in terms of those managerial skills that makes you confident about where they can drive their company within the AI sector or in space?
Well, I think we're at a moment where a lot of the playbooks that we've had in SaaS software for at least the last 10, 15 years are really having to get reimagined. So you have to come in with a very first principled view of what this opportunity looks like for AI. And so in that regard, we tend to look for leaders that have a little bit more of a product focus, a little bit more of a builder focus, and that really will help them really imagine what the possibilities are in terms of building this future that's emerging right in front of them. And so when we look at a new founder and what they're bringing to the table, more often than not, a bit stronger understanding of what could be built and really having strong knowledge of what's already in this space, specifically when it comes to what the foundation model builders have already developed in terms of core abilities that the models now provide out of the box. You want to be able to stay ahead of that very acutely as the market continues to evolve. And so those are the qualities that you really need as a founder going into this market at this present moment. And that's certainly what we look for in how we invest in founders and companies, particularly post 2022.
That makes a lot of sense when you think about what you're seeing and thinking about these opportunities. And I mean, the sheer volume of money coming into AI is the other thing that makes it stand out. You did make the point of having something unique, understanding the build. Like, I think that's so important. But then with this money pouring in, eventually your investors, all investors, are going to expect to see some money out. So looking down the road, broad terms, sure, the giant private companies can stay private easier, longer than ever before. But when you're thinking of the companies that aren't valued at digits that defy explanation, you know, do you see public offerings for AI companies coming down the pipe in some time frame?
I think at Insight, we really just think about where growth would occur. And as long as that growth is occurring in a very valuable strategic area, there will be liquidity opportunities available. And we saw that in the last several years, right? You saw the number of strategic exits that came about. We, of course, saw a number of IPOs that also occurred. So as long as growth is there, you will certainly find an opportunity to strategically exit the investments you've made or potentially go into public markets. Going into 2026 and 2027, we see those all as opportunities for great investments, particularly when growth is available, particularly around the software categories that are now either transforming into AI or the ones that are natively built post 2022 as AI first companies.
Great. And so leaning into that M&A question a little bit, and winners are going to win, if you'll forgive the cliche, sorry. But when you're talking about M&A, like, do you see that if there's any potential where some of these larger companies are actually buying up some of the smaller ones as they seek to take advantage of opportunities and perhaps providing some smaller wins for those companies that aren't necessarily going to be the winners?
Yeah, I think when we look at some of the incumbents that are particularly in this space, I think there's opportunities for two things to occur. One is just consolidating your existing domains. And you're seeing that particularly in certain markets like CRM and GTM tools, you're already starting to see that some of that consolidation play out this past year. You're also going to see, call it the incumbent that might not be as AI native now start to look at acquiring companies that are more AI native in their to their specific domain, their software sector. And both of those things are really going to play out going into 2026 and beyond.
Great. George, I said this was going to go fast, and it did. I wish we had 30 minutes to talk through, but unfortunately, our time is done. This has been awesome. Thanks for sharing your thoughts with Axios and our audience and helping make them smarter that much faster. Again, George Matthew, Managing Director at Insight Partners. Thanks very much.
Thank you.
And thank you all for joining Axios' final Dealmakers event of 2025. We really hope that throughout the year, we have made everyone smarter, faster, and we look forward to bringing you more of these types of events in 2026. Now, for more on what's happening across deals and deal making, visit axios.com/pro for all that we offer at Axios Pro Deals. And with that, thank you all for joining. Have a great new year.